Hi everyone. So we have finished test one and we are diving into chapter 4. So we're continuing learning about our accounting cycle out here on Canvas. So I've got the steps. So we learned about recording journal entries, posted to the GL, and did trial balance. And that was chapters 1 through 3. Chapter 4 is talking about adjusting journal entries and adjusting trial balance. And then the rest of the steps are in chapter 5 down there, so you can kind of see where we're at. If you want to click on this Prezi and go through it, that's fine. It's a little bit more advanced because it's what my Principles of Accounting class does. So instead of confusing you guys by doing that, it's out there. You can read through it. I'm going to go through the textbook with you in this video. But essentially, adjusting entries are needed to bring our matching principle into play and our revenue recognition principle. So our matching principle says that we have to match our revenues and expenses in the period in which they incurred. Doesn't mean that's when they were paid. It just means when it happens. Revenue recognition principle means that we recognize the revenue when it is realized and attainable. So sometimes we have our customers pay us up front for money for services, and we haven't done the work yet. So we learn about unearned revenue, and we owe that to our customers because we haven't done the work yet. But our revenue recognition principle says that once we do the work, once it's earned and realizable, we can go in and record it. So we have to make these adjusting entries to get our accounts to reflect what really happened in the accounting period. So I think your discussion question kind of talks about that. Some have already answered the discussion question, and you guys have kind of been putting some vague answers, which makes me wonder if you've read the chapter yet or you're just going off a Google search or what. But the purpose of the discussion questions is to kind of re-emphasize what's been going on in that chapter. I don't mind that you work them ahead, but at least read the chapter before you answer them so you're kind of on track with what's going on. So when I pull up the e-text out here in my lab, it talks about the accounting cycle. And we have a worksheet and we talk about the trial balance. But before I dive into that, what they do have is a wonderful figure or picture for you to kind of describe the accounting process. If you don't like a list, you can see it visually. So all of our business transactions happen, and then we journalize them in our journal. It's the book of entry. And then we post them into the ledger, which we learn about is all of our accounts and what are their account balances. And so that's called the final book of entry. Then we go in and prepare a trial balance, and that's where we have to find out, do our debits and credits equal? After that, this worksheet is optional. Sometimes if you're using like QuickBooks or some type of computer system, the worksheet is not done because it's all done electronically. But if you don't have the computer system and you have to do a manual thing, you can have this worksheet. Now, even though the computer system maybe does the worksheet for you, you may still have to do your adjusting journal entries and adjusted trial balance, enter them in like you would up here with these regular transactions. So the worksheet just helps you get your accounts in order so that you can prepare your financial statements better. So remember, we have 3 financial statements. They have to be prepared in order. We have income statement, statement of owner's equity, and balance sheet. They flow from one to the other, so that's why they have to be prepared in order. All right, so what this worksheet does is list all of our accounts, all of our chart of accounts, and they're in chart of account order. And from the trial balance, we learned we put them in as debit or credit, right? Then we'll learn about what adjustments happen. Now, adjustments do not affect cash. They are all non-cash adjustments to move some things out of liabilities, maybe to move some things out of other assets and to record expenses, but no cash will be involved. Then we calculate a new trial balance just to make sure that our adjustments were done and we had our debits and credits that equal. Then after that, you can use this worksheet to prepare what accounts go on income statement, what accounts go on the balance sheet. So our adjusting entries, these are the types of entries that we're going to have. Supplies, we have an adjustment to our prepaid accounts. We have an adjustment for depreciation for our fixed assets, and we have an adjustment probably for some type of accrued expenses. So what happens usually with supplies is we buy these supplies and they're sitting on our shelves. We get down to the end of the month and people have come and taken supplies out, and we count our supplies and we find out we have X amount in there. Well, on our books, we have to adjust it for all those supplies that were used during the month, because every time someone comes to our shelf to pull supplies off, we don't necessarily record it. So we make an adjusting entry at the end of the month. And so that's what they're talking about here, is if you started out with $600 and you go and count and it says on hand at the end of the month was $100, then how much of that did you use up? $500. So we have to adjust our computer supplies account to show we used up $500 of supplies. So how do we record an entry when we use something up? Well, expenses involved, right? So we would debit our supplies expense and we would credit our supplies account, which is the asset, to make our account balance down to $100, right? So when we go over here, they're kind of talking you through that. Computer supplies expense is increasing, so that would be a debit. Computer supplies is an asset and it's decreasing, so that would be a credit. So that is how you would come in and do your debits and credits. And so the balance in the supplies account after we do that credit is now $100. If you had to do a journal entry, you could post your journal entry. So what they're showing you on the worksheet here is the supplies wasn't in this, or supplies expense wasn't in this listing. So you add it to the bottom. Those are the supplies that we used up and we debited that account. And then we also have to credit our supplies account. So your ending balance in supplies over here would be $100. Now, the next category they talk about is rent. So we have a customer come in and they pay us rent. Well, hang on, let me say that backwards. We are paying our rent up front. We paid for 3 months rent up front. We get down to the end of the month and we've used up 1 month of rent, right? So we've got to adjust our prepaid rent account to show that we don't have the full 3 months in there. We only have 2 months left. So if we started out and we paid $1,200 up front, and our prepaid rent account, as you can see here, is $1,200, and we've used up a month of that, then how much is 1 month of rent? We'll divide it by 3, right, because the $1,200 represents 3 months, and that leaves us with $400 per month. We've used up 1 month, so we would have to come in and credit our prepaid rent, and we would recognize that we've used the rent, so it would be a debit to rent expense. So when you come in and they talk about the journal entry, you would debit rent expense and you would credit the prepaid rent for the amount of rent that was used up during that month. So now they've come in and added rent expense on their worksheet, and they've adjusted the prepaid rent account by $400. Come in, our next adjusting entry is where we talk about depreciation. So when we buy what I call a fixed asset, something that's going to live for longer than 1 year, we put it on our books according to the cost, and that's the historical cost principle. Those assets aren't going to live forever. You can only use a computer for so long and then it becomes outdated or useless. You can only use a vehicle for so long. You can only use these fixed assets for so long. So they have a life, how long they're going to live for, per se. Each period, we have to adjust them for how much we've used them up for. So that's what depreciation is. Now, when you come down here, we'll go over this in more detail in later chapters, but probably next semester. The basic way we can calculate this is called a straight line method. So you take the cost of the equipment and subtract out how much is going to be left after after we're done with it. Or you could think about it like almost like your salvage value, how much you could sell it for, or how much you could get for it after you're finished with it. So that's what residual value is. So take the cost, subtract the residual, and divide it by how long it's going to live for, how many years. So like a vehicle might be good for 5 years. A building might be good for 20 years. A piece of computer equipment might be good for 3 years. However long it's going to live for, or its years of usefulness. Once you do that calculation, it tells you how much per year you use up of that asset. So they came in and said the equipment was $6,000. It was going to be have a residual of $1,200. So that left us with the amount we can depreciate of $4,800. Divide it by 5 years, and it comes out to $960 per year is what we're going to use up of that fixed asset. Now, to do the journal entry and to record it, we come in and we can't adjust that computer account. We have to leave it on the books for what we bought it for. So we come up with a new account called accumulated depreciation, which is a contra asset account. It means it does the opposite. So if the normal balance of the fixed asset or the computer account is a debit, then the accumulated depreciation account would have a normal balance of a credit. You see, it does the opposite. When you add the computer account to the accumulated depreciation account, it would be like a positive plus a negative, and so essentially you get a net book value. So all of our adjustments for depreciation are going to go to the accumulated depreciation account. If this is throwing you off and you're not sure and it's not making much sense, you may just have to memorize these accounts in this journal entry. For depreciation, you will debit the depreciation expense. You will credit accumulated depreciation. You'll have to calculate the amount based on the scenario. So they've given you some examples. Different companies can estimate their life at different things, but those are just some examples of what some companies have done. Accumulated depreciation is tied to its fixed asset. So for every fixed asset, and fixed asset I mean by some asset that's going to live longer or be around for more than 1 year, accumulated depreciation is tied to it. So if you have an equipment account, you have an accumulated depreciation for equipment. If you have a building, you have an accumulated depreciation for building. Land is never depreciated. So you will not have an accumulated depreciation account for land, but all the rest of those that are fixed assets will have an accumulated depreciation account. So in the book, they go through and they talk about these, and they show you that journal entry, and they talk about book value, or net book value is the same thing. So it's the equipment account less the accumulated depreciation account for that equipment gives you the book value. Then they show you how they added that in the journal entry. Now, accumulated depreciation was not up here, right? So we have two accounts we have to add, and we have our debit and a credit in our worksheet. All right, the next adjusting entry is an accrual entry. So we have to accrue expenses. The common one they give you has to do with salaries. So if you want to think about your salaries, let me get my pen out here and let me draw you. Where'd it go? It's not showing up. Why is it not showing up? There we go. All right, so let me draw you a timeline. So we have our timeline. All right. If this is the end of the month, whoops, sorry, let me erase that. Let's say we have a pay period and we're going to get paid. Oh, I have to move my squiggly. Okay. We're going to get paid on October 4th. Okay. And we have a 2-week pay period. And let's come in and say September 21st is the first of our pay period. So that represents 2 weeks. Well, the end of the month falls in here, in between our 2 weeks, right? September 30th. So what happens is we have to record per our matching principle the revenues and expenses we've incurred during that time period, even if we pay them or don't pay them. Well, we're not going to pay our people until October 4th, right? But the end of the period says we have to recognize all of those expenses that we've incurred from the 21st through the 30th. So what we have to go in and do is accrue expenses. We have to recognize and put on our books that we've had salaries expense for this time period, for those days, even though we're not going to pay them until later. So the difference, what is that, like 9 days? These 9 days, we will put in and debit our salaries expense account, but we will credit salaries payable because we're not going to pay them until October 4th. But we have to put it on our books that we've incurred that expense. So that is what that journal, whoa, I lost it all together. Hang on. That is what our journal entry is coming in and doing when they talk about this accrued expenses. So they do it on a calendar here, but sometimes timeline works a little bit better. So when you get these situations, you have to watch. It may tell you how much per day or how much is going on. So the journal entry is going to be to debit the expense account and credit the payable account. You may have to do a little bit of calculation. It may tell you flat out, like they do here, that it's $350, or it may tell you so much per day. But however the problem is set up, these are the journal entries you're going to do to record it. So they show you in the worksheet, they have office salaries expense already in here and they're adding to it, but they didn't have a salaries payable, so they add that at the bottom. So we've got our adjustments in there. We're going to subtotal those up. And so the sum of our debits of adjustments have to equal the sum of our credits. And then we have to go in and finish the rest of the worksheet. You have to do an adjusted trial balance. So on the next, this kind of gets hairy here. So on the next, whoa, that bites. Can we rotate it? Well, that's not much fun. Okay, well, flip your book when you're looking at it. They subtotaled these adjustments, right? Well, they went in and did an adjusted trial balance. So now you're carrying over. So I believe this was the cash account. Well, there were no adjustments, so the balance stays the same. Same thing with, what is this? Accounts receivable. So this balance was $5,000. There were no adjustments, so the balance stays the same. When you get to supplies, it was $600 on the debit. We had, oh, this is hard. We had a credit of $500, so what is the balance in that account? $100 on the debit side. So you're balancing per row. You're going across and figuring out what the adjustments were. So you guys may want to look at page, what was that, 118 in your book, and make sure you understand what it's talking about. The other part that after you do your adjusted trial balance, you come in and start working on your income statement. So what of those accounts on that worksheet go on the income statements? And what of those accounts go on the balance sheet? So let's flip over. Maybe they'll have this flipped around. So they come over here and they list these accounts, right? And we say on our income statement is our revenues and our expenses. On our balance sheet is our assets, liabilities, and equity. Now down here, we added salaries payable, but remember it's a liability, so it does go on the balance sheet, so you have to watch your accounts. So when they finish out the worksheet, they just carry those balances over into whichever column. Is it on the income statement or is it on the balance sheet? When you get down here at the end, you have to total up your debits and credits for the income statement column. They should not equal. One should be larger than the other. The difference represents your net income, and then you can subtotal them again and they will balance. Preparing the income statement. Okay, so they got our page flipped again. So there was your income statement. Then when you come over here, you're going to copy that net income line over here on the credit side, because we would increase our capital account, right, by the net income. And you're going to balance your balance sheet account. Oh, more sideways pages. This is not fun. So they're just walking you through how they verified those accounts. Your statement of owner's equity is not done on the worksheet, but you essentially, it's because you roll over your net income into your capital account. And so they just talk through that. I think you guys can read and see how they just carried things over to the actual balance sheet off that worksheet, and it helps them prepare their numbers. So that is it for chapter 3. So hopefully, or chapter 4, sorry. It's chapter 3 in the financial class. But I'll do separate videos talking about homework, but that should give you a good overview about this chapter.